In a world where financial comforts are built on paper assets, we assume these contracts will be honored, much like a promise sealed with a handshake. But what if I told you that the warehouses supposed to back these promises are being quietly emptied, leaving institutions with little more than a neatly printed lie? Welcome to Comics, where the disparity between fiscal reality and contractual illusion is about to become the trigger for a historical market upheaval. On the COMEX stage, the ratio is a staggering 378 paper ounces to every real ounce in their vaults. Just this past week, a mass exodus of metal has seen 33.45 million ounces, over a quarter of their registered holdings, vanish into the ether. Lease rates for silver have soared to a staggering 8%, compared to the historical norm of just 0.3%. These numbers don't merely represent abstraction, they are the alarm bells of an impending structural collapse in the precious metals market. The market's knee-jerk reaction, predictably, was a frantic grab for physical silver as prices rocketed. In just 2 days, silver surged past previous highs, reaching nearly $100 an ounce. This isn't just another price rally. This is the financial equivalent of shouting fire in a crowded theater, with everyone scrambling for the exit, but few understanding the real cause of the blaze. But here's the catch. While the masses see an opportunity for gain, the reality is that this fiery ascent is built upon a structure as unstable as a house of cards. The disparity between paper contracts and physical assets sets the stage for a force majeure, a situation where COMEX simply cannot meet the obligations of their contracts. Think of it as a bank run, but instead of cash, investors are looking for silver that simply isn't there. Machinery of doom. Let's draw back the curtain on these complex mechanisms. Picture the financial system as a giant plumbing network. The COMEX is one of its many pipelines, supposed to channel fiscal liquidity. In theory, the contracts it issues should be backed by physical metal, part of the assured flow of this system. However, the unprecedented scale of the discrepancy now mirrors a pressure buildup in those pipes, threatening to burst them wide open. Compare this to the 1970s, when inflationary pressures forced the closing of the gold window, and treasures were suddenly visible only on paper. Or perhaps more vividly, recall the 2008 financial crisis, triggered by overly leveraged mortgage securities. History teaches us that when systemic trust erodes, collapses are swift, catastrophic, and unpredictable. The Federal Reserve, meant to be the system's regulator, faces a liquidity trap. We analogize to a chess zwang. Any move aggravates the situation. Raising interest rates risks a broader economic recession, while lowering them could spur further inflation and erode trust in paper money. The delicate balance needed here is akin to walking a tightrope across a yawning chasm. The secret war. While everyone else sprints for paper profits, the whales are making moves of a different sort. Institutional giants and those wielding insider knowledge recognize the need for tangible assets. This isn't mere speculation. It's preparation for a post-illusion financial landscape. They are silently amassing physical silver and gold, shifting their assets beyond jurisdictions where paper entitlements could be rendered worthless with the stroke of a pen. For companies rooted in production like Tesla or Apple, the stakes are even higher. The rare metals they utilize aren't just resource staples. They are critical components in electronics and technology. Tesla's gigafactories, for instance, hold a vested interest in a stable supply chain of nickel, cobalt, and yes, silver. As sanctions and geopolitical tensions fragment supply networks, their strategic pivots to secure supply through ownership of raw materials are necessary, not optional. The geopolitics of now sees the West wagering on paper dominance against the Eastern Bloc's grasp on physical resources. The Shanghai exchanges are already trading at premiums, indicating a market where physical availability sets the real price, echoing the ongoing tug-of-war between fiat exuberance and tangible scarcity. Surviving the shift. And so we hollow these realities down to the grassroots level. Your mortgage, your savings, your retirement fund. In this environment, what is the real value of your nest egg if the assets backing it crumble to speculative dust? Fixture costs driven by inflated asset prices will cascade through every financial layer you depend on, putting your future plans in jeopardy. Looking forward 6 to 12 months, the roadmap appears jagged and fraught with uncertainty. While the mainstream may continue to latch onto the specter of market optimism, the undercurrents we discern tell of a time when those paper castles tumble down, unable to sustain the weight of fiscal truths. Action is required, not passivity. The strategy is clear: secure tangible assets. This is not investment advice. Rather, consider it an existential strategy. Like a lifebuoy against financial tides, you must think like the banks, acting contrary to their public advisories. Acquire physical metals, evaluate real estate for essential occupancy rather than speculation, and diversify beyond singular currency dependencies. As we close this analysis, remember, the financial system's narrative is shifting from a paper tale to a story etched in metal and mineral. It's a transformation not just of markets, but epochs, recalling that the most enduring currencies throughout history were never printed, they were mined. The silent signal. Picture this. While mainstream media floods you with colorful charts and upbeat reports, behind the closed doors of the vaults in New York, something unnerving is taking place. Precious metals, specifically silver, are being extracted at an unprecedented rate. It's not just a trickle, it's a flood. These aren't random withdrawals, they're strategic, and they foretell a looming crisis. Institutional investors pin their hopes on paper contracts at the COMEX, unaware that the silver supposedly backing these contracts is disappearing. When this bubble bursts, they might find themselves with nothing more than void promises, an IOU with no substance. Examining the fundamental chaos, consider this. The conventional ratio of paper-silver contracts to the actual physical silver is 378 to 1. It's indicative of a market living in delusion, a digital empire built on grains of sand. Over just 7 days, COMEX saw an egress of 33.45 million ounces of silver, amounting to a staggering 26% of its entire registered reserves. If you're still clinging to those ETFs and futures, take heed. This isn't just a statistic, it's a countdown to disaster. The market's visceral reaction wasn't subtle. Bonds, often the market's canary in the coal mine, sent distress signals. Safe haven treasuries saw yields dip as liquidity seeks solace. In tandem, the dollar wavered, revealing anxiety beneath its veneer. Silver leasing rates, traditionally sedentary at 0.3%, have erupted above 8%, signaling desperation in acquiring physical metal to cover obligations. This isn't a mere ripple, it's a tsunami building off the financial coast. The gearing of destruction. Now let's thread through the complexity of these mechanisms. The intricate plumbing of global finance resembles a Rube Goldberg machine, each segment reliant on the precision of interconnected parts. As COMEX attempts to juggle its paper-silver commitments, the creaking sound of impending failure grows louder. The liquidity trap has ensnared them, reverse repos and Basel III requirements constricting their ability to escape this cyclical tightening. To truly grasp what's unfolding, cast your mind back to the tumultuous 1970s or the cataclysmic year of 2008. These weren't mere economic hiccups. They were systemic revolutions compelled by reckless leverage and untamed speculation. We're witnessing a similar arc. It's cyclical, yet exponentially more complex. Central banks are in a Zugzwang, a German chess term denoting a position where any move worsens their plight. Whether raising rates to curb inflation or lowering them to stimulate growth, each move is a grand compromise that fuels the fire beneath this financial powder keg. The covert clash. As the masses remain fixated on surface movements, the financial elites are orchestrating their endgame. In hushed tones, behind vetted security, these titans of industry are shifting their weight to physical assets. As paper contracts transform into liabilities, they accumulate gold, silver, nickels, and other tangible wealth in hidden vaults, steering their portfolios away from fiat vulnerabilities. Companies like Tesla and Apple, whose lifeblood flows through strings of global supply chains, know this game all too well. Their factories, driven by the demand for nickel and cobalt, lean precariously on reliable silver access. As logistics lines buckle under geopolitical strain, they hoard these raw materials, laying groundwork for their survival beyond the fiscal breakdown. Contrasting this bid for resource sovereignty, the geostrategic chessboard is reset. The Western commitment to paper wealth teeters against the East's command of genuine commodities. In Shanghai, silver fetches premiums reflecting a stark truth. The price on a screen is but a fraction of what the physically scarce metal demands. The road to survival. The macroeconomic tapestry we've analyzed paints a dire picture for individual livelihoods. In such an environment, what is the future of your mortgage payments or retirement plans when markets implausibly buoyed by speculative air begin to contract? As paper assets shrink, their fall cascades through our economic foundations, shattering financial security into shards of what once was. Forecasting the next 6 to 12 months, the outlook is not simply uncertain, it's fraught with peril. While public optimism might sustain appearances, the bedrock we've excavated reveals precursors to a collapse that paper assets can no longer support. Anticipate the need for action. Think tangibly, not abstractly. Secure physical assets in metals. Evaluate real estate for tangible utility, and diversify currency dependence. This might not be investment advice, but consider it an imperative for financial resilience, a lifeline amid economic riptides. Let's leave with a lasting thought. We are transitioning from an era of paper illusions to one where metal and mineral narratives prevail. This isn't merely a market transformation, it's an epochal shift reminiscent of eras past, where the genuinely enduring currencies were not printed. They emerged from the earth, mined from the bedrock of tangible value. Silent whisper of a collapse. In the busy clamor of financial markets, where headlines scream the inevitable peaking of silver prices, lies an undercurrent of silence, deadly and piercing. This is not just another blip on the stock tickers. It's the silent countdown to an unavoidable crash of the paper empire. While investors fix their gaze on the fluctuating charts, silver, a cornerstone of true value, is vanishing from the vaults of New York. Soon, grace periods will end, and instead of hefty bars, hollow IOUs will be handed out like consolation prizes. Let's dissect the blood-red ink on this deal. The current ratio of paper to physical silver on COMEX stands at a staggering 378-1, a mirage of prosperity that will evaporate under scrutiny. This isn't just an anomaly. It's a structural earthquake ready to pulverize any unsuspecting speculator betting on derivatives rather than hard assets. Over mere days, COMEX has seen withdrawals of 33.45 million ounces, nearly 26% of its registered reserves. Meanwhile, lease rates on silver have soared to 8%, up from a negligible 0.3%, indicating a market hemorrhaging metal faster than cheap paper can be conjured. As the market falters, the pain is tangible. Bonds, currencies, and precious metals scream in financial agony. The Treasury yields, defiantly hovering above 4%, clash with an inflamed geopolitical atmosphere, proving again that the market's superficial tranquility is a veil. As institutions scramble, caught in a vicious short squeeze, their portfolios are suffocated by a felt shortage no paper can mask. What seems like a temporary spike might be the prologue to the grand unwinding, the sputter preceding the full-scale crash. Mechanics of death. We take a long dive into the depth of financial instability, a peek into the pressure cooker that is now the global economy. The mechanics are intricate, akin to an old plumbing system corroded by years of neglect. Reverse repos Basel III regulations. These aren't just terms. They encapsulate the unsolvable puzzles of liquidity that central banks face today. Like a Cessna trapped in a storm, navigating the yield curve between chaos and more chaos, each step is more concession than choice. Let's recall the ghosts of 2008. Similarities echo with resonance. Derivatives, toxic CDOs, and the implosions of confidence are back, threatening to reprise the mistakes of the last financial cataclysm. Unlike then, the levers of control have become strings of a puppeteer's failed illusion, ready to snap. The liquidity noose tightens as there's no safe exit. Central banks find themselves in a bind. They're cornered into a checkmate. Whether it's keeping interest rates absurdly low or absorbing the insolvent credits languishing from balance sheets, the options only worsen the outlook. The covert clash. Unbeknownst to the public, the intelligent elite are orchestrating a subtle yet systematically explosive game of wealth reallocation. Behind closed doors shrouded by high security, they are stealthily transitioning from monetary illusions to assurances made of minerals. As paper contracts morph into liabilities, gold, silver, nickel, true reservoirs of wealth, fill secluded vaults rather than digital ledgers. Corporations integral to the global economic fabric recognize this geopolitical paradigm shift. Giants like Tesla and Apple, whose empires rely on a delicately balanced act of supply chain magic, now hedge their futures on the security offered by stockpiles of essential minerals like silver. The stories of innovation are overshadowed by a covert scrabble to stock up on the materials that alone can ensure supply continuity and survival through the breaking point. The East versus West dichotomy in geopolitics is laying down a critical confrontation. The age-old reliance of Western economies on paper transients embarks unlikely sailing in the face of Eastern resource dominion. In regions like Shanghai, silver isn't just a commodity. It's a testament to rebellion against an era of digital illusions, with premiums pointing to a truth far palpable than digital figures suggest. The road to survival. In this dim portrait, consider the real impact on individual portfolios, retirements, and mortgages poised perilously on potential collapses of speculative balloons. What becomes of the promises written in ink, but tethered to speculative wind, when the inevitable deflation occurs? A market reliant on air soon bursts, and what remains are fragments of unfulfilled promise and security. The next 6 through 12 months offer a grim script of uncertainty if left unaddressed. Public optimism shouldn't mislead. Beneath the symptoms of economic disarray are apparent. There's no room for complacency. Action becomes the only defense. Pivot investments towards hard, substantial securities, metals, strategic real estate, diversified currency portfolios. These aren't just advisable allocations. They're lifelines, not a proposal for investment, but a pragmatic ethos of safeguarding. An era is ending, another taking its place. From an epoch marred by paper dreams to one hewn from the core of tangible wealth, the materials that narrate continuity in history's deepest chapters. This isn't merely a shift in financial markets. This is redefining eras, where true currencies aren't coined from machinery, but mined from Earth itself, tangible, undeniable. The bedrock of intrinsic value, a legacy from the arid sands of financial disruption. Imagine a room cloaked in shadows, the stark outline of vaults hidden behind layers of iron and secrecy. While most investors are glued to flickering screens showing endless graphs and ephemeral trends, something monumental is transpiring in these silent sanctuaries. It's an exodus, not of people, but of precious metals, slipping away under the radar as electronic contracts balloon into phantom obligations. We're speaking of the vaults in New York, from where silver seems to sublimely vanish, leaving only hollow promises echoed in paper receipts. The slick sheen of the latest news is a trap. The staggering ratio of 378 paper contracts to 1 physical ounce of silver makes headlines. But what it really signals is the looming fragility in the very system. A withdrawal of 33.45 million ounces over a mere week from these supposed bastions of security isn't just a minor mishap. It's akin to watching a critical social construct crumble, brick by brick. Interest rates for borrowing silver, typically near zero, spiked to 8%, a vivid symptom of the shortage strangling the market's throat. Now comes the market's visceral cry in response. The whispers on Wall Street turn into roars. Government bonds shiver as currencies waver, rallying around assets presumed safe, yet now exposed. The surge in precious metal prices isn't an ascent born of euphoria, but a ballet of desperation, dancing to the tune of short squeezes and supply constraints. The twisted irony is in motion. As confidence in fiat ebbs, the supposed security of printed promises falls apart at the seams. For a deep dive, consider the underlying complexities here. The mechanics at play are not unlike the intricate workings of a grand clock, each cog representing rules and realities from eras gone by. The curve of yield, seemingly benign, twists into a precarious slope. Remember the days of 1970, when the gold standard unraveled, or 2008's financial quagmire, if you will. Basel III regulations, designed as bulwarks against chaos, reveal their limits. And, trapped in a reverse repo menace, a liquidity sink, the Fed trains a precarious balancing act with droplets of cash. History's echoes reverberate. Does the specter of 1929 sound familiar? Where, then, is the safety valve? The central banks face a chessboard of options without a win. Each move, each change of rate, only tightening the noose. It's financial chugzwang, a check from which escape seems mythological. As the masses beguile themselves watching market tickers, a clandestine war unfolds hidden by numbers. Kites, or elites, the subterranean giants, hoard tangible metals while publicly touting digital derivatives. Meanwhile, industrial titans like Tesla hungrily secure their shroud of physical silver. It's the commodity needed to fuel dreams of energy transition and tech proliferation. The stakes are ruthlessly real, a bidding war not just against competitors but against time itself, because the vault may not restock at present capacity. Consider the geopolitical fissure of East versus West. In the East, Shanghai exudes an aura not of beads and screens, but of soul, with silver traded at earthly premiums, a vote of no confidence in paper pretense. The West, marooned on mere promises, senses the looming storm. They know, though mightily deny, that paper's age is waning. Nations like China, aware of paper's phantom, pivot towards resources, making monetary strategies underpinned by tangibles the modern anthem. Every grand narrative boils down eventually to the personal, the intimate. How secure are your savings when the market feels volatility stripped of precedent and paper homes in on its endgame? Consider your mortgage, a once secure bastion, now teeters on the precipice of an inflationary abyss. Savings? In question, if pinned solely on digital endorsements without substance. The next 6 to 12 months project a tapestry of unpredictability to the prudent. Ignore the sheen of prospective forecasts, for beneath, an economic murmur sings of discord, unease, and cracks unseen by the naked eye. Each hesitance to act further erodes one's financial standing, and thus your sole refuge is in transformation. It's not mere advice, but a directive. Transition portfolios towards assets with weight and gravitas, physical metals, and strategic real estates, perhaps dalliances with diverse currency hedges. This isn't investing, it's insurance, the sort that deters demise in the uncertain days. The narratives we abide by are changing with time. As the epochs spin the wheel from illusions spun on fiat webs to histories shaped on metal foundations, we stand on the brink of a material rebirth. True wealth, it appears, carves its path not through digital miasma, but through tangible essence, structured, mind, and eternal, a new tenure dawning post amidst the grindings of a financial maelstrom.